Well, investors and consumers have abandoned one of Australia's biggest retailers. Shares in department store Myer dived more than 11% today after the company slashed its profit outlook, raising the prospect of a fall in annual profits for the first time in 5 years. The retail giant's poor performance was reflected in soft national retail sales numbers for December, suggesting that consumers are battling headwinds. Here's Philip Lasker.
Shoppers were throwing their bodies around in typical fashion last Christmas, but not necessarily their money.
The Reserve Bank hiked interest rates in November, and the banks increased their rates by more than that. We had petrol prices going up during the quarter. We had a fairly sort of ordinary end to the year for equity markets. So I think consumers generally were just feeling that things weren't that great.
The December retail sales numbers weren't really that great either, with sales up a modest 0.2% as the floods also started taking a toll in Queensland. Sales of discretionary items like clothing and household goods did well, but the biggest component, food, was down for a second straight month, and it was an uncharacteristically bad time for department stores. But at least cautious consumers will have jobs. Job ads in newspapers and on the internet rose for the 12th month in a row to a 2-year high.
We'll still get job growth for the first half of this year. I just don't think we'll match the record jobs we saw during 2010. So again, it's a reason for consumers to be a little bit cautious, but the news is not all bad.
It must have seemed all bad for Myer shareholders. The retail giant has slashed its profit guidance for the financial year after being hit from all sides.
A combination of both deflation coming from aggressive discounting, the interest rate rises which started in November that certainly had an impact on consumer confidence, the unseasonal weather, particularly the lack of warm weather, and the volatile seasons that we're encountering, and also the floods.
Back in November, the company expected a profit increase between 5 and 10%. Now Myer says profits could be down by as much as 5%, the first slump in 5 years. The retailer's margins are being squeezed, particularly in clothing where it's a big player.
November and December were challenging. However, we were online from a profit point of view. However, January is, we've seen a rapid deterioration in both sales and consumer confidence.
Investor confidence in Myer took a big hit as well as the stock dived more than 11%. At the same time, Myer's announced it has bought 65% of fashion house Sass and Bide.
Call me cynical, but I think that's a side issue. I think it was conveniently timed to come out today to possibly detract from the fact that the Myer business is actually seeing its earnings base go down since IPOing. It's possibly strike one for current management. And I suspect there could be some mildly negative news still to follow, given the retail climate.
The climate seemed far kinder to HiFi, where margins rose as the electronics retailer said it was on track to increase profit by at least 13% this year as it opens more stores.